On March 1st and 2nd, there was a short but significant divergence in the correlation between Ether and the Nasdaq. Now, the theory at the time was that the decoupling was the beginning of a new role for crypto as safe haven asset in a time of global stress. However, this did not last long. By the end of that same week, Ether and Nasdaq resumed their correlation in a downward trade, while more traditional risk-off assets like gold and silver moved higher amid the escalation of geopolitical tensions. Now, there's also a question of potential government regulation. Just this week, the White House laid out a comprehensive strategy for the federal government's treatment of cryptocurrency. Now, from a broad perspective, the battle in the crypto space has always been the race toward large-scale and institutional adoption versus the potential for government regulation. Bitcoin enthusiasts have long argued that crypto was designed to handle these hurdles and should be fine in the long term. However, other more casual participants are obviously not as convinced. Now, if a trader believes that Ether could continue to trade in lockstep with risk assets like Nasdaq, and that the potential is for a spike higher, perhaps on easing geopolitical tensions, they could buy the March Micro Ether futures contract at 2740 and target the December congestion area of 4,000. A stop for this trade could be placed at 2,200. This trade could make $126 if your target is reached, or risk $54 if you're stopped out at your level. Now, conversely, if a trader believed that the risk to Ether is to the downside, perhaps because of the potential for increased regulation, they could sell that March Micro Ether futures contract at 2740 and target the mid-2021 lows of 1,800. Now, a stop for this trade could be placed at 3,100. This trade could make $94 if your target is reached and risk $36 if you're stopped out at your level.